So this panel will explore how macroprudential authorities can address the challenges involved in implementing a system-wide approach to stress testing. The panel will be chaired by Deputy Governor Aino Bunge of Sveriges Riksbank and Vice Chair of the ESRB Advisory Technical Committee. The Deputy Governor will introduce the panel members and lead the discussion. Over to you.
Well, many thanks for the introduction, Connie, and also thanks to the organizers for inviting me to moderate this panel, the final panel of today, which will be very topical. It will relate to system-wide stress testing, and I'll have 4 very distinguished participants that I will introduce in just a moment. But I think this panel connects many of the issues that we've discussed today, but also brings them down to the level of what do we need to do then for financial stability or to address systemic risks in our area of expertise and in our mandates. And I think the panel that related to emerging threats to the financial system, we heard both Loriana and Cornelia discussed how much the financial system has changed since the global financial crisis. And especially for Europe, we see the bank-dominated financial system also now being complemented by non-bank financial intermediaries taking an increasingly important role, and it's also becoming much more interconnected and complex. And then, of course, we have all of these other threats that we've discussed today, geopolitical threats, threats from new technology, threats from climate change, and as we've seen in the last couple of years, even from pandemics that can translate into risks for the financial system. So the question is then, how do we address this, and how can we safeguard the stability of the financial system going forward? And it's clear that we need to identify and address the systemic threats, and be able to test how the system would react during different scenarios going forward, and see how the interactions between different financial intermediaries would be during those scenarios. So system-wide stress testing hopefully will play a role in this. And we already see stress testing taking place, but clearly there's much to do, and there's also new technology that may take this further. And our host here today, ESRB, the EU Macroprudential Authority, has as a key component in the strategy going forward to develop stress testing, system-wide stress testing for Europe in collaboration with its members and, of course, also with the ECB. So my hope is that this discussion today will be something that will actually be a catalyst in that process. And to help me with that, like I said, I have 4 very distinguished participants. And behind me, first, thank you for connecting with us from a distance. We have Acharya, who is connecting from the US. And as I can see even on your shirt, you're the CV Starr Professor of Economics at the Stern School of Business. And, but you're not only an outstanding academic, has also been the Deputy Governor of the Reserve Bank of India, and in different capacities provided advice to different authorities and central banks, including my own, but also institutions as the BIS, the IMF, and the World Bank. And the list is longer, and I know that with your extensive insight into systemic risk in the financial system and its regulation, and especially the dynamics between banks and MBFIs, we can think about how these questions relate to system-wide stress testing and how they can be used. And then to my left here, I have Nat Benjamin, who holds a doctorate in applied probability from Oxford University, and is now using that in the Bank of England as Executive Director for Financial Stability, Strategy and Risk. And you're also a member of the Financial Policy Committee. You joined the FSA already in 2004, but you also have extensive experience from international bodies. And I understand that during the global financial crisis, you worked both in the UK and then at the New York Fed. And when you returned to the UK, you have also been deeply involved in stress tests of major banks, but now we're also interested to hear about your systemic stress test work. And then to my right, Rama Cont, Professor of Mathematics and Chair of Mathematical Finance at the University of Oxford, Senior Fellow of the Institute for New Economic Thinking. And your research focus on mathematical modeling of financial risks and applications of machine learning and AI in finance. So that relates very well to the last session that we had. You received many rewards for this work, including on systemic risk modeling, where you received the Royal Society Award for Excellence in Interdisciplinary Research. And you also have extensive experience in being an advisor both to central banks, but also to private institutions such as central counterparties and fintech firms. So it will be really interesting to hear your experience in talking to different types of organizations. And finally, John Fell, Deputy Director General for Macroprudential Policy and Financial Stability at the ECB. And you have a unique experience in stress testing and also scenario design, including during stressed scenarios, such as during the pandemic, and how you use these tools for practical purposes during those times. And you represented the ECB in several international fora and groups, but since we are here at the ESRB, I would especially highlight that you've been playing a key role in the ECB stress testing task force and been on board from the beginning when designing the stress testing scenarios for the European systemic risk supervisory authorities and the stress tests that have been taking place there. So a warm welcome, and I'm sure that you share my view that we have a very distinguished panelist that will be able to answer any questions that you and I might have. But I will start with a quite general question, and I will give it to you first, Viral, to answer. And it's basically, so why do we need these system-wide stress tests, and how can we use them? And what do you see? What role do you see for system-wide stress tests going forward? I mean, there are hurdles, and how can we develop this tool going forward? And I will give this question to all of you to start with a more sort of general view on the area. So please, Viral.
Yes, yeah. Thank you, Aino. My apologies for not being there in person. I've had some health issues over the summer. But let me just give a view on stress tests, the macroprudential stress tests, more generically, and then specialize it to what context might they be useful as far as the non-banks are concerned, as far as systemic risks stemming from non-banks are concerned. So my view has always been that the reason why we do stress tests is because the capital requirements go out of whack with reality. The risk weights are static. They are anyway statistically calculated based on some historical data. And then they are not immune to the Lucas critique that precisely the risk assets that have the lowest risk weights will be the one that will become the preferred avenues for risk-taking by the financial sector. So in practical terms, what this means is that doing the stress tests and revising the exposures of risky asset classes to specific macroeconomic scenarios gives the supervisors and prudential regulators the opportunity to dynamically revise these risk weights. They might be used for supervisory or prudential capital purposes. So I think viewed this way, I see the stress tests as being a way of addressing the Lucas critique, but also partly recognizing that there's the risk that risks will change. Mortgages might have been historically stable, but they were not so. Their underwriting quality went for a toss prior to the 06-07. So if we had done a stress test in 06-07 that was sufficiently responsive to changing market conditions, changing underwriting quality, we might have picked up some stress. And not to cherry pick on a bank, on a central bank, but Reserve Bank of India got a soft landing on the 07-08 crisis precisely because it reacted in that way through provisioning and capital norms to retail mortgage risk that was building up in the banking system in '06. Now, so the second aspect is the non-banks. So I think you could consider non-banks as a version of Lucas' critique. Viewed cynically, non-banks exist partly to loosen the requirements that are put on the banking system. They may be technologically dominant in some manners as well, or that may be an endogenous consequence of the regulatory arbitrage, which is that hedge fund managers move from inside the perimeter of the banks to outside the perimeter. And then the expertise is, of course, with hedge funds. And it's no longer with the banking system. So I don't want to get into splitting hair about whether non-banks are technologically more efficient than banks or not. But it's certain that they are not subject to the same rules or not in a congruent manner as work of Metric and Tarullo puts it. And then there are slippages of risks back to the banking system because banks are the ultimate providers of liquidity to the financial system. And that's because of their access to stable and cheap deposits. That's because of their access to deposit insurance. And it's because of their access to implicit backstops like the lender of last resort or emergency liquidity assistance from central banks that at least first accrues to the commercial banking system, and it's opened up only on the fly with some uncertainty for the non-banks. But that's more a response to stress rather than being automatic. And so there is slippage of risks in this manner, both at the ex-ante stage, which is in the creation of risks, and at the ex-post stage, which is in the transfer of risks back to the banking system from non-banks through their credit lines, through the liquidity support that they provide, through the automatic stabilizers that the banks seem to be when the systemic risk materializes. And in my view, macro stress tests have the potential to shed light and empower the regulators and supervisors with an ability, with the information and the ability to react to slippages of risks of this type. So one is the dynamic inconsistency of the capital charges and the liquidity weights and so on, even within the rubric of the current structure of the rules. And the second is a little bit out of the box to recognize that there are risks in the rest of the system that can be taken care of if you take a holistic view, which is what a macroprudential stress test should do, in my opinion. Let me stop there.
Well, thank you so much for that initial comment, and we'll come back to some other issues. But then, Nat, your view on this and your experience from the UK.
Yeah, thanks very much, and thanks very much for having me. So why do we need system-wide stress tests? Well, in a nutshell, I think it is because the financial system has evolved, and so we need to evolve how we assess its ability to support the real economy. So we need to evolve our toolkit in a way that is consistent with how the system itself has evolved. And others have talked a lot about how the provision of those vital services has changed over time, especially after the global financial crisis. And I would say, so there's a much greater presence of market-based finance in addition to banking supporting the real economy. Doesn't mean banks are less involved, far from it. They're just involved in a very different way. They are by far the main providers of leverage to non-bank institutions. So it just shifted the way in which they are involved in that provision of vital services, and we just need to have a toolkit that evolves accordingly with that different set of roles and responsibilities on who does what. And it does also mean that we need to be able to answer a much broader set of questions than just, well, has this firm got enough capital, yes or no? Because we need to ask a much broader set of questions to testing and how to use those system-wide stress tests. And I come back to the one we did last year. It's literally to point at ways in which market participants should prepare themselves for shocks. so that when shocks hit, the market is able to self-stabilize and absorb the shock themselves. And we've seen the benefits of greater market resilience in the course of recent years through various bouts of turbulence, which markets were able to self-absorb to some degree. So that is a very positive thing. But that is one of the main benefits of system-wide stress tests, is to help people update and improve their playbooks for when shocks do happen. So specifically, and I sort of and linked to what Vera was saying, is to ensure that the market does its job of being the first line of defense, so that central banks and authorities can be the last line of defense for the most severe scenarios. I would emphasize the focus on the resilience of markets. We talked about how the roles and responsibilities have shifted from individual institutions to market-based finance. And that is very much, I think, a necessary focus for system-wide scenario exercises, which is to focus on markets rather than individual institutions within those markets. And it's a bit of a mindset shift, and in a sense, we are more interested in the resilience of core markets or a range of markets that support the economy than we are in any one individual participant in those markets. So specifically, I mean, if a hedge funds get into trouble and that has very little impact on core markets, then, well, that is their problem. It's not our problem. So that change in focus on the market is quite important. Because market-based finance is more prominent as a source of vital service to the real economy, it means that the ecosystem that provides those services is now more interconnected. And that is a key feature of system-wide stress tests that helps working out how those behaviors play out in a shock and under a range of scenarios. So that's why it's particularly suited to that type of exercise, to understand the interactions, understand the interlinkages, the feedback loops between the actors, which we wouldn't find out by doing the classic stress testing of focusing on individual institutions. So the major benefit of the system-wide exercise that we ran last year, which was focused on core UK markets, so the gilt markets, the gilt repo market, associated interest rates derivatives plus the sterling corporate bond markets, was to basically provide full transparency on the behavioral response of the different actors in that ecosystem. And a key feature that we used to achieve that was to do it in 2 rounds. Is a sort of a flow test rather than a stock test, like the classic ones, is we impulse the shock across the ecosystem and observed the reaction of the actors to that shock, and then played it back to those same actors. So specifically, we had a number of non-bank players who assumed they would have access to some form of financing, some extra repo, for example, from their broker-dealers. Well, we went to ask their broker-dealers, would you give them some more repo? And I said, no, there's not going to be more repo for them. So we told them, well, you're not going to get more repo, so adjust your playbook. Same thing on the sterling corporate bond market. So those are the types of things you can find out by testing out almost in real form, the behaviors of the different actors in the ecosystem, which you cannot do in a stock one-off shock that you impulse. So that's a major benefit, which is well suited to market-based finance generally. In terms of the future, what we do, so we're doing 2 things. First, we're investing in our ability to continue to monitor the answer to the same exam question, but in a more lighter touch way. So we involved, it was the first time we did it, we involved more than 50 different participants in that system-wide exercise, from banks, insurers, hedge funds, asset managers, and et cetera. And we had really good engagement, really good feedback, possibly because we didn't do the exercise to, punish anyone by adding more capital or adding more liquidity rules. It was just literally to find out what would happen. And there was definitely a mutual interest from all the participants in finding out what would happen for a range of reasons, not least because a number of those firms use those markets as part of their business models. And that's finding out what would happen without necessarily regulation coming in any part of that is an important aspect of this thing, but help everyone understand how things would play out and help everyone improve their playbooks so that when shocks do hit, people are better prepared. The second thing we're doing, in addition to enhancing our database capacity to monitor how things, how the same test would play out, given that exposure shifts over time, is to potentially test other ecosystems. We talked in the past and earlier this morning about the private finance ecosystem, like private equity and private credit. And we said in our last financial stability report that one of the things we would do, we talked a lot about the benefits of private finance, we talked about the risks of private finance, but it's a pretty interconnected ecosystem, as Cornelia said this morning. And we said we would step up our engagement with actors in that ecosystem to better understand how it would respond to shocks so that it can continue to support the real economy through those shocks, especially given how crucial it is to productive investment, for example, in the economy. So we are having those type of conversations with participants, and the system-wide exploratory scenario toolkit is sort of that is a topic that is a good candidate for that type of tools. In terms of the challenge of doing all these things, I would say, data and transparency is always a challenge, but the big help that we have from system-wide scenarios is that by virtue of this behavioral test of doing it in several rounds, that flow test, you can do almost a mark to reality of what would otherwise be just modeling assumptions. And that is a huge improvement in terms of stress testing technique, is to test it directly with the people who would be making the decisions. Let me stop here.
Well, thank you so much. And I think we'll hear that we are talking, when we talked about system-wide stress tests, sometimes we talk about system-wide stress tests in one economy. Sometimes we're talking about the EU level, sometimes we're talking about top-down, and sometimes we're talking about this more interactive stress test. But coming to you, Rama, so that you've been advising then also organizations like central banks and discussing this. How do you view system-wide stress tests going forward, and what do we need to actually come forward in this area?
Yes, I think to understand the concept of system-wide stress testing and why it's useful, it's maybe interesting to contrast it with traditional stress testing. So in the classical stress testing approach, which has been widely used also previously before the financial crisis, the idea is that you view a financial institution as being exposed to exogenous shocks, and you want to assess the capacity of that institution to withstand these shocks, and then determine some capital or liquidity requirements, for example, or other types of requirements to withstand these shocks. Now, these shocks are defined in terms of scenarios, but these scenarios are externally defined and then applied to portfolios of banks or other financial institutions. And this is based on the idea, which sounds intuitive, that for a financial system to be stable, it is necessary and sufficient that all its components, in this case banks, if we're talking about the banking system, are stable in the sense that they're able to withstand a certain level of exogenous shocks. Now, in systems theory and also in economics, there had been a lot of there had been some early work indicating that this assumption is not necessarily true, that you can have a system, and in this case, for example, a banking system, where the components are able to withstand shocks in isolation, but when you put them together and when you take into account their interlinkages and interactions, and the feedback loops which are inherent to the functioning of the financial system, the same shock scenario may destabilize the system. This doesn't look so intuitive, but it was very present in the early work, for example, of Martin Hellwig, even Hyman Minsky, others, Rocher, Tirol, Vives, and others. But I would say people would agree in this room that it wasn't taken very seriously by supervisors until 2008. It was there in the background, but not many. It didn't translate into any supervisory practice. And the main idea was the first one: check that the components are sound, and this is the basis of macroprudential supervision. So, going from this classical stress testing to system-wide stress testing means putting in what's missing, and what is missing is the institutional links between these institutions that are composing the financial system, the interaction channels. It can be lending and borrowing, exposures, funding relations, market relations, and so on. And then taking into account the feedback loops which result from these channels. And this was done at a theoretical level pre-2008 because the data to actually calculate these things was not there. And what we've seen is that people after 2008 started taking this idea seriously. Regulators have mandated some data reporting requirements which have now enabled to build databases which can be now used by researchers and central banks to actually explore these systemic feedback loops. And now we do have a quantitative idea of how important the system-wide aspect is, and whether indeed these channels of interaction can have a destabilizing role. And of course, this is because we did see them having a destabilizing role in 2008. So the answer is affirmative, is not so surprising after having seen this, but it is still very important to quantify the exposure of the financial system to these different channels. And so system-wide, I prefer the term systemic stress testing, allows to quantify these channels. And this system-wide stress testing, it gives us additional information compared to the stress testing, standalone stress testing of individual institutions composing the financial system. For example, it does give us ways to quantify the exposure of the system to different contagion channels. Once we know this, then the regulators can take measures through macroprudential policies to mitigate these channels. But for example, it is not obvious today, after all the implementation of the measures post-2008, which channels are the dominant ones in terms of the system vulnerabilities. These need to be constantly monitored and quantified because they keep changing as the structure of the financial system changes. And so some of the things that cannot be extracted from standalone financial institution stress testing, but are outputs from system-wide stress testing, are exposure to these contagion channels, exposure to global imbalances, and also there's this concept of indirect exposure, which I like a lot to emphasize. When you have a system, a financial system with interconnected components, it is the case that financial institutions can be exposed to some risk factors which they may not directly see in their portfolios. They may not take them into account because they think they're not exposed to them because their holdings do not reveal such exposures, but because they're embedded in a financial system where they're connected to other institutions or mechanisms or markets which they are exposed to such risk factors, these institutions may end up having indirect exposures. And this is, for example, if you asked banks a few years ago, what are the risk scenarios to which they are most exposed in terms of their results, I think very few of them would have thought a pandemic or a conflict in Ukraine would be on top of the list. But here we are. So these indirect exposures may manifest themselves through supply chains, through interlinkages in the financial system, through other mechanisms that are geopolitical. But only an authority like a central bank with access to a broad set of data across institutions and markets can identify these exposures and then communicate them to the financial institutions, or take or adopt a macroprudential policy to mitigate risk. So I think this system-wide stress testing reveals much more information than standalone institution stress testing. So that's obvious. But today, from the standpoint of central banks who have now this data and the capacity to conduct these stress tests.
Well, thank you. I think that connects both to the other presentations. But finally then, John, this journey from stress testing on a more microprudential level to system-wide stress testing, how do you view that?
So a lot has been said already that I agree with, and I'm going to try and approach the answering of your question from a slightly different angle. So we're already doing banking sector stress tests in Europe. We're doing insurance stress tests, we're doing fund stress tests, and we're doing CCPs. So, I mean, I think the question for us really, as from the policy making side, is what does system-wide stress testing bring that those sectoral stress tests don't bring? What is the extra? What are we getting that is more? And I thought about maybe 5 reasons. I think it's more like a kind of a 3+2 because I really want to emphasize a few points that I think are important. The first, Nat mentioned it already, specifically interconnection. And if I use a kind of an aviation metaphor, let's see if it works. It's a bit moving from, if we're thinking that the baseline is those sectoral stress tests, it's a bit like moving from flying a plane with nothing more than a navigation chart, that a system-wide approach gives us a radar. Back in 2020, you mentioned it in your introductory remarks, at the outbreak of COVID, I was chairing the ESRB's task force on stress testing, and we got one of those what-if questions. Actually, the call came from Thomas Peltonen, and the question was, what would happen if rating agencies decided to downgrade issuers of corporate bonds on a massive scale? I remember the call very well. we were homeworking at that point. And this was a very plausible scenario because we had been talking with market participants, market intelligence, and people thought that this really could happen. And the way that it would happen, why it would become a systemic concern, was because of what it would have meant for the holders of those bonds if they were downgraded. Because you would have had some investment funds who had mandates to hold only investment grade. And if they're downgraded below that, they're forced to sell. It's one reason for why you get forced selling. And of course, the question then was, what we needed to know was where were the exposures, and how would a forced selling scenario transmit through the system when there are other holders of the same bonds. And I think that was, that was something that a sectoral stress test really couldn't, I think, have brought. I mean, the second thing, these are part of my kind of top 3, is the dynamics, and I can extend my aviation metaphor a little bit further. This would be like moving from having a navigation map plus an interconnection radar. Now we have a flight simulator. And here, most of the sectoral stress testing that we do in Europe is done with a static balance sheet. So the institutions are not responding to the stress. So really just we're seeing a kind of a balance sheet sensitivity. I mean, I'm saying that now in crude terms. It's more than that, but it's not showing, what would happen if institutions responded to the scenario. And what came out of that exercise was that you get huge amplification effects. there's a forced selling, of the funds that are the passive funds that have to sell first, and then it's like that's the first day, then a week later it's active funds and so on, and you get. We saw amplification effects of 20, 30, even 45% in the most extreme variant over the baseline. So that was a big additional impact that was coming from the stress, that dynamics. Tail risk, I think, follows from the previous two. I think system-wide stress testing is going to be much better at capturing tail risk in the financial system than other approaches, because they're capturing those feedback loops that Rama mentioned. Then the other two, I think comparability, of course. We do all of these sectoral stress tests, but how do you compare the results across them? One, of course, is the differences in scenarios, but common metrics to gauge risk. And the fifth then that I would mention, and Nat mentioned this at the beginning, is the European financial system is evolving towards a more market-based, we're a little bit lagging the UK financial system, but still it's becoming more market-based, and we want it to become market-based because we have this big push for CMU, savings and investment union, and so on. And let's see now if I'm really pushing the boundaries of my metaphors. It's going to bring more air traffic. Quickly on, because I think I'll only end up repeating some of the points that are already made, and I don't want to duplicate. I fully agree with what Matt said. I think that the role, how we can use them as a policy planning tool. We can use them for crisis preparedness, for crisis management. So as I said, it was very interesting to find out that day T+1, it was the passive funds that were selling, then it was the active funds on T7, and then it's insurers and pension funds. You probably saw all of this from your interactions. One thing, I don't know, and I think it's worth, I think spending some time on the panel on this point is the whole thing about, and I think you were giving away something about the Bank of England exercise on policy response, how you would respond. You had calls back from the funds, and they wanted to know how you would respond. I think you can do variance. I think it's useful to have a baseline, but I think it's also because we were a bit overtaken by events during COVID, because then we had all of this policy response, and by the time we went through all of the drafting process that are involved in central banking, crossing T's and dotting I's, the report was rendered a bit redundant. But I think we learned a lot about data gaps, about dynamics, about all kinds of other things, and that's where I think those are where the hurdles are. Data gaps, metric alignment. If we were to be doing this on a regular basis in Europe, I think we have to discuss governance, follow-up. And then there's the whole issue of how to deal with moral hazard and what communication and what you would actually publish at the end of an exercise. I think we showed a lot in the report on what we did. But because policy had already responded, we didn't have to confront this challenge.
And of course, that was a very extreme situation, but thank you so much. I think some of the points that you're bringing up is of course that it would be great. If we had this complete view of the financial system and interconnections, etc., that would be great. And the question is then, perhaps also a little bit on the limitations. So we think this is something that we want to do it. What are the limitations? Some of you talked already about data gaps, but also then come back to this question about policy responses, because you brought up this question, how can this inform macroprudential policy and regulatory action? So I'll give this, start with you, Viral, again. How do you view this? So clearly you give good reasons for having these kinds of system-wide stress tests, but what are the limitations and how would you use them when you get the results, taking those limitations into account as well?
Yes, so I think some excellent points were made. And my sense is the way the regulatory and supervisory stress tests have proceeded till now is that while they make the regulators think about the feedback loops and second order effects and amplification mechanisms, they are not explicitly a part of the stress tests that are being done. Maybe regulators are innovating in some jurisdictions through choices of stress scenarios. Maybe in some jurisdictions they are improvising by looking at how much they model the stressed drawdowns on credit lines of banks in certain scenarios. Is it specifically risky for the NBFI sector, and so on. But by and large, my sense is, and I think this is only amplifying the point that the other panelists made, by and large, my sense is that it still takes a sort of a static view of the financial sector. Anything dynamic is probably nuanced and requires sort of additional intervention from the regulators from the stress in the stress test toolkit. But what I wanted to say was, even within the context of the limitations that we have, which is that inherently they are not general equilibrium or second order or amplifying the scenarios that they consider. Even within that limitation, I think we could do a more holistic view of the financial sector. And I think I want to stress this point, which has also been made by the other panelists in some form, which is that increasingly we are getting open to thinking that central banks are the liquidity backstops for the entire financial system. It's not just for the commercial banks, but they are even for the non-bank financial system. They are for the markets as a whole. I think that genie has left the bottle, as far as I can see. In fact, there are proposals being put on the table to institutionalize some of the central bank support for the non-banks through standing repo facilities and all that. And I think my sense is, like I think since the word moral hazard came up, I think this has happened without thinking more about what the powers of the central banks are over these non-bank entities in their risk-taking. Because I think with regulatory arbitrage, we can be sure that pockets of risk are, pockets of systemic risk are developing in the non-bank system, which is the unregulated part or lightly regulated part of the system. But with the central bank put of liquidity attached to these markets and the institutions which are non-regulated or lightly regulated, we can almost be sure that these pockets of risk will be systemic imbalances if over a period of boom times. So one, the regulators might get caught up in a black hole or a blind spot if they don't pay attention and gather information and monitor these non-bank connections. Second, as I stressed, risks may travel back to the banking part of the system through credit line drawdowns and the implicit transfers of liquidity that take place if the banks are the automatic stabilizers first. But third, my sense is, I think we could use even the existing apparatus of the stress tests to regulate the non-banks indirectly. So let me give you an example. So to just make things concrete, there's concern about the leverage of fixed income hedge funds betting on the US Treasuries market. They are trying to pocket some carry trade profits, long short positions, cash futures arbitrage, and so on. I think there's probably some 14, 15 of these hedge funds all over the world, but they are using prime brokerage services from banks that are part of the regulatory stress tests in the United States. Maybe not all, but at least some of the large prime brokers are indeed stress tested in these services. Prime brokerage involves, custodian services, collateral valuation services. It includes emergency provision of liquidity. It includes portfolio margining and so Like we could use the stress test data that the Fed collects, that the central bank collects on these institutions. So these positions are there. And it could be a requirement that the stress tested positions reflect margins or haircuts which are higher than what are privately charged to be countercyclical. At the extreme, you could require them to validate and ascertain that the hedge funds they provide prime brokerage services to are not above a certain leverage. And if so deemed suitable, it could even be a fiat, non-linear rule that hedge funds above a certain leverage operating in the treasuries market cannot be granted prime brokerage services. Now, there'll be enforcement requirements that have to be thought through. How do you ascertain that the leverage that was stated of the hedge fund ahead of time won't be the one that's in the stress test scenario? But it seems to me that even within the limitations of the existing stress tests we have, given that regulators are being more and more nuanced about what they think are the stress scenarios, the fact that we are stress testing now insurance companies, funds, is already a recognition that market stress is becoming a problem for central banks to say no to it when it comes to injecting liquidity and mass in the system. So my sense is we need to be a little more open to using stress tests as a way of curbing the risk-taking and the slippage of risks and leverage that's risking the amplification that is moving into the non-bank system. There are new kids on the block, like private credit and bond markets, which have grown tremendously after the global financial crisis. And I think even if we don't have executive powers over these institutions, we don't have legislative powers to regulate them, we could design rules in a way that gets at their risk-taking and leverage. We can still use the fact that banks are the primary liquidity providers in order to layer a set of rules and risk weights, dynamic risk weights, punitive or non-linear functions of regulation that get at some of this problem. Because otherwise, I'm concerned that right now, central banks are in an ever-expanding role of providing liquidity support to non-banks without even gathering information, without using this information, and indirectly in a nuanced way, using it to regulate the non-banking system. Like even when they don't have explicit powers, as I said, we could implicitly put some risk constraints on the parts of the non-banks. So to summarize, my sense is there are limitations. I think they stem more from even expanding the set of models we have to factor in the relevant second order and amplification effects, the feedback loops as we call them. But even within the limitations, we could do possibly more by enriching the data we have and expanding the scale and the scope of central bank intervention with banks in order to get indirectly at non-banks.
Well, thank you. I can see that you're eager to also jump into this discussion, Nat, right? So I'll give I think it's related to the question, but because when you describe your stress test, it's a lot about informing the market and making sure that their playbook is sort of adapted to reality. But of course, as Viral is mentioning, part of their playbook could be that they are relying on the central bank to step in and to take action. And how do you view this? But perhaps also put in some words on what's been limitations in your work, and how do you feel that you need to develop this going forward?
Yes, so I would say the way I would think about the set of issues that Viral mentioned is the following. So first, just on the specifics of our system-wide scenario, they are dynamic by construction. So that is the main advantage of them. So they are a flow test. They happen in 2 rounds, in which we change the scenario based on what happens in the first round, so that we test out whether there are some amplification dynamics going on in the ecosystem. So that is definitely the case. And the broader question is, what is the link between the system-wide stress test and policy making, policy question? Back to Viral's point, I do think the primary use of those scenarios, which is to help everyone, us and the participants, understand better how shocks would play out, that is a key policy tool for us, because it helps each individual participant understand what avenues would or would not be open to them should the shock happen. And it does mean that as and when the shocks does happen, well, their playbooks has been updated, and therefore the collective ability of the market to self-stabilize after the shock is greater. And we have seen some of the benefits of that in terms of improved resilience of some of those markets through the various episodes of turbulence and volatility that we've had over some years. So basically enabling the market itself to be a stronger first line of defense is a key objective of those system-wide stress tests. Having said that, there's always going to be a set of scenarios for which we need to have the tools in our toolbox to be ready to intervene. The idea being that for severe but plausible shocks, that is the job of the private sector to deal with. But when it goes beyond that severity, it's important that authorities have tools in their toolbox, and we've got tools in our toolbox to do that. But in terms of the link between the system-wide stress test and policy making, I'll give you one example, which was very striking when we did ours, which is one of the areas in which we had to prove some assumptions wrong. So some participants were assuming they would get some extra repo from their broker-dealers. We asked the broker-dealers, and broker-dealers said, no, we have no further risk appetite to give more repo to those participants, unless they are cleared, unless we deal with them via a clearinghouse. So that is the link to a potential policy measure, which is to move the clearing of repo, of government bond repos as the default, the standing position, something the US has moved to in the past. So that is a very clear link, and it illustrates that is one measure, central clearing, that has the capacity, and we tested it out through that scenario, to actually increase the potential supply of liquidity if there's a shock, because there's greater willingness of providing that extra liquidity if there's a clearinghouse and all the safeguards that come with a clearinghouse. I mean, if you're a broker-dealer, it's a much less risky proposition to face a clearinghouse than it is to face a standalone bilateral non-bank. So that's just an illustration of how you can use the learnings from a system-wide exercise to illustrate the benefits of some policy actions. We also saw that a big part of the liquidity calls that came out of our scenario were due to the fact that a number of, many haircuts were zero, like absolutely zero, and were dialed up very late in the day, which generated extra liquidity measures. That also points to things, proposals that have been made in the past. So that's an illustration of how you can use system-wide scenarios to link it to, okay, what does that mean to policy actions that could be taken in the future to enhance the resilience of core markets?
Thank you very much. So, Rama, during lunch, you and I were also discussing this about data sharing. When it comes to EU, that's always an issue. How we perhaps have a lot of reporting. How do we share data? How do we use that data? And that's something, and also new technology. Could you say something about how you view opportunities, perhaps, in that also uses new forms of technology to look at things?
Yes, well, I think when we speak about system-wide stress testing, one of the first things is to define what we mean by the system. So how wide is the system? And so a narrow understanding of that is the banking system of a given country. So this has been traditionally the way that central banks have seen that, just because that's a jurisdiction and that's where they can collect data. But increasingly over the last 2 decades, people have been looking at, first of all, the interaction between the banking sector and non-banks. We have heard a lot about it today. Insurance, pension funds and asset managers, money market funds, and so on. So there, where's the data? And for example, the Bank of England has done a very interesting work on this, both in terms of collecting data and looking at historical data to see how these institutions have interacted with the banking system in the past and how they react in certain shock scenarios. I think this is crucial. There's this gap, this data gap, if you may, in many cases. And then in Europe in particular, although many national central banks do conduct system-wide stress tests at the level of their country, this sounds to me not a very interesting exercise, because if you look at any country in Europe, Europe has, the financial system in Europe is very highly integrated. So it is very difficult to find any country in Europe where the main risk exposures lie within the geographic zone of the country. They're often the many risk exposures would lie outside the geographic jurisdiction of the national regulator. So in the Eurozone, it's really but defining the perimeter of the system as the country, the national system seems actually not very realistic, because that would give us a very incomplete picture of what's going on. So there are some data gaps where, as Viral said, one can still do without and draw some useful conclusions, some meaningful conclusions. But this is not one of them. I think you really need to consider, define the system as the smallest perimeter for which it is meaningful to ignore as a first approximation the exposures to what's outside. Otherwise, or at least have some information on exposures to what's going on outside, the external shocks. Otherwise, the exercise can be very, rewarding and etc. But the results may not be very interesting or meaningful. So that's in terms of data. Now, of course, in the European context, the data sits somewhere. And here the ESRB has a very important role to play in federating the data access and trying to collect this data and do a more federated exercise here. But as people involved in this kind of exercise all know, data sharing is an issue. And to be frank, I never quite understood why, because it would be in the interest of national regulators to collaborate on this, but it turns out that it's a thorny issue. Turns out that national regulators, you please feel free to contradict me, are reluctant to share data on their national financial institutions with others, and even with the ECB or with the ESRB. So this has hindered meaningful exercises in this respect. There are some success stories, such as, for example, the ESMA CCP stress tests are really looking at a wide range of things, but in the case of banks, it has been very difficult. So I think this is something that the ESRB can be instrumental in overcoming, given its role and its positioning, and I think that's a requirement. Now, often when people think of data sharing, they think of importing data and then storing it on a computer and then having people access that. Actually, that is not necessary. There are in other areas, not in central banking, but in other areas, we do have protocols for data processing which do not require the user to actually import the data or see the raw data, but rather there are secure protocols which allow you to send a request to a database, perform some calculations which are seen by the owner of the data. They're supervised, so they may not allow you to do certain calculations. They may allow you to do other ones, and then export the results without actually violating the privacy requirements of the core database. So I think maybe these possibilities have not been explored in the case of central banking, and maybe that is a thorny issue of transferring the data that can be resolved by using these technologies. So maybe that's an answer to the question you were asking about data. But beyond the data, I think one of the other issues that John alluded to, and also Nat and Viral, is the assumptions in stress tests on the reactions of financial institutions to shocks. So in classical static stress tests, this is not an issue, but as John said, in some of the scenarios considered in system-wide stress tests, that's an unrealistic assumption. We cannot assume static balance sheets over in these stress scenarios. And in fact, some of the feedback loops and contagion phenomena stem from the fact that there are certain reactions of financial institutions. And so this is, I think, something that we need to still refine in these models. For example, there has been a lot of work on fire sales. The fire sales is one extreme type of reaction in a stress scenario. Fire sales can be triggered by various types of things like regulatory requirements or holding or ratios and so on. But beyond fire sales, which is like the extreme case of reaction, there are other types of reaction to shock scenarios where it's important to understand the reaction, for example, of non-banks or hedge funds in certain stress scenarios, whether they will be acting as shock absorbers and stepping in to provide liquidity, or on the contrary, withdrawing liquidity. This type of thing is actually crucial to understand the stability consequences of certain scenarios, and we still don't understand this very well. And for this, we need to, so fire drill exercises like some of the things done by the Bank of England, and careful study of data from past episodes can maybe help us go in this way. So I think these are two different dimensions where I see improvements but necessary.
Thank you. I can see you looking at us thinking we're talking. We need to have also a question for the audience, but therefore I need you, John, to help me then to summarize it, because you brought this up as well, the policy action, that is usually that was a limitation in the COVID episode. It had already happened, but that's one limitation. Could you say something more about things that you feel that we need to develop going forward?
Time is running, and a lot has already been said, but I mean, if I were to pick one thing that I really would hope system-wide stress testing would be able to help us with. Well, first, I think we've got a good handle on credit risk, we've got a good handle on market risk, but it's liquidity risk where we are, very far behind, and we are not good on solvency, liquidity, spirals. Now, I wouldn't be forgiven if I didn't mention and give some prominence to the ECB's ESA, but in so doing I need to find the acronym. Because it's not actually an acronym, but we have the interconnected system-wide stress testing analysis, in case you were ever wondering where the ISO comes from. It'll be a test afterwards to see if you remember the acronym. But being more serious, we're working on trying to, figure out these second round loops, deposit repo withdrawals, new repo fund redemptions, all kinds of amplification loops and so on. And I think that is really where we're really hoping, to shine a light, on this. I mean, if I may, on the issue of data. And what we need, we always talk about data, And yeah, I mean, it's in my list here of the limitations. I mean, I already mentioned a lot, but I think we need also, and I mean, I think I have the benefit, the last panelist to speak at the end. So I think we need to be humble and we need to be modest about what we know, what we don't know, and what we can't know, even if we have lots and lots and lots of data. Yeah, I thought about how I could maybe phrase this, but you know, and one language that I think framework that works well, it's an old one used by the former U.S. Defense Secretary Ronald Rumsfeld, and you may remember he spoke about known knowns. So that in our world that could be exposures, accounting losses, and so on. Known unknowns. We're talking here about dealer capacity, margin calls, redemption dynamics, things that we know about but we're uncertain about. And then we have unknown unknowns. These are the cross-sector interactions that we cannot see. Maybe they come out of the type of exercise that Nat was doing. There is a fourth. There's the unknown knowns. They're the things that we don't know that we know. I think they're kind of redundant in this space. But I think I sometimes have a kind of public LinkedIn discussions with John Danielson from the LSE, and he's an expert, as you know, in systemic risk. And it triggered my memory on a wake-up call that I had a long time ago on a market intelligence meeting. You know, we do a lot of market intelligence. We speak to market participants to kind of understand about, you know, what are their concerns about sources of risk to financial stability. And I like to do my homework before those meetings. So if I can find something out about the counterpart that I'm going to meet, I will try to dig it out. So, I mean, in the US, they have the SEC's Edgar database, and it gives the whole portfolio exposure that within, I think, 40 to, I mean, I think within 6 weeks at the end of the quarter. And so it's really up to date. And I was meeting this hedge fund manager, and I was able to see his portfolio in the Edgar database. And I thought I'd struck gold because I saw that he had a huge position in a well-known company that at the time, this is some years ago, and I don't want to, you know, identify because I didn't tell him I was going to mention this, but the company was in Chapter 11. It was all over the newspapers at the time, and I went into the conversation with him really to challenge his appetite for risk, because he was always portraying himself to me as someone who managed risk very carefully. Now, maybe I should mention it was a company that was in Chapter 11, and he was a distressed debt investor. Would anybody have an idea why a distressed debt investor would have a long position in equity in a company in Chapter 11? I'm not going to put anybody on the spot. I didn't at the time. And he explained that what I was able to see was like a kind of a mere tile of the mosaic of his portfolio. And he didn't explain. I think he was kind of even disappointed that I kind of thought that might have been a risk for him. But curiosity got the better of me, and I didn't want to repeat the same kind of embarrassing moment again if I ever confronted that situation again. So, I mean, I just got Chapter 11 equity. It's usually, you know, close to worthless. It's really risky to invest in Chapter 11 equity. But given that he was a distressed investor, what looked like a very risky long position was actually not really a bet on the stock at all. It was probably a tactical piece inside that mosaic of a complex cross-structure trade. And most likely the fund was actually exposed in the higher ranking credit, hedged with CDS, and owning the equity, this is really interesting, gave him, because he had a lot of shares, gave him voice in the restructuring discussions with the debt holders. So that put him actually into a very powerful position, a blocking stake potentially. And so what looked like something, because I had the data and I was able to see a really risky position, actually turned out to be not risky at all. So yeah, I think that we really, the whole knowing what the incentives, the motivations are behind the exposures, it's crucial to understand those, because without them, you know, we are Yeah, I mean, we're at risk of well, what I call, giving false alarms. So I think we really have to be careful and modest with, both our expectations and what we can do, but not give up trying.
So thank you. Since we have only a few minutes left, I would like to leave some time for questions for the audience, but I would just like to say that really illustrates the complexity that we're looking at now. And of course, we need both then macroprudential supervision that looks deeply into each exposure and the system-wide stress test. But please, if you have a question, raise your arm and then also state your name so you will get, I think I have one and also here front. So first, if you had.
Thank you. This is a question for John, because you stated that common metrics are key to compare results, which is not to be put under question, of course, but I just wonder whether you were making reference to a consistency over time or across sectors or across jurisdictions.
I mean, I think I was speaking at a very high level on that point, but I mean, I think, if you're going to run a system-wide stress test, you want to have some kind of, common metrics so that you can make comparisons to say, this scenario is, or that vulnerability is, a bigger risk for the insurance sector than it is for banks or whatever. I mean, I think there are lots of attempts out there to do that. Are you skeptical on the possibility of actually doing that? No. But I think we kind of need to do it.
Now, if I may, I'm just skeptic about ensuring such a consistency across jurisdictions. But sure. I see the value, and I was sure we're mainly talking about consistency across sectors because of what you said before. And if I may, sorry, I forgot to mention who I represent here today. I'm Martina Tambucci, and I work at the Italian Consob.
You wanted 2 minutes on that?
Yes, I just wanted to respond to what John said. It turns out that every time I go to a central bank conference, somebody in some speech says, we are in unprecedented times.
I didn't say that.
And somebody, you didn't say that, the first speaker said that. And somebody quotes this Rumsfeld thing. Okay, never fails. Okay. And I just wanted to react to that because it is, of course, convenient for risk managers and regulators to blame everything on unprecedented times or unknown unknowns. But I really don't buy that, because if we take the examples, for example, if we look at Silicon Valley Bank is not about unknown unknowns.
No, it was all there.
It was a classical exposure to
it was a known.
Interest rate risk, any standalone, non-system-wide, regular stress test would have picked it up. And the usual rules on capital adequacy and liquidity and so on should have been applied and should have fixed the problem. They didn't. So it is not the case that the knowledge we have, the data we have, are being exploited and the consequences of the experience we have had in the recent or not so recent crisis are being applied. It is not the case. So I would not blame these episodes and the failures and the accidents that keep happening again and again on unknown unknowns or unprecedented times. As some colleagues would say, people say always it's unprecedented times. That's because they have short memory. So I think with the data we have, with the methods and simple models that we do have, there is a lot that can be uncovered if these methods are applied properly, and if the consequences are then, if there's a consequence to the outputs of these models, there needs to be a governance to the results of stress tests. We talk a lot about stress tests here, system-wide or not. And something we didn't talk about is the governance. So once we have a system-wide stress test which indicates a vulnerability, then what? I think if we do act on the data and the models we do have and the results, there's a lot to be improved. So I would just be even more humble than John and say, we are not even using the resources that we have right now. And this is even more surprising given that after 2008, we have had a lot of mandatory data reporting imposed on the financial sector. We don't have a lot of people from the private sector here, but they would obviously have their point of view on it. It's costly. Collecting it is costly for the regulators. Processing it is costly. Warehousing it is costly. Are these data being actively used in monitoring of risk? I don't know. It seems to me that it's underused. We have lots of data, much more compared to, say, 2006. Are we much more knowledgeable about the mechanisms underlying the financial system? Are we monitoring the risk in the financial system in a much more precise and granular way? A little bit, but not that much more. So that was my final.
Thank you. I think that means that we have a lot more work to do. Unfortunately, we're running out of time, but I saw that Abdelaziz was raising his hand. So one very short question, and then perhaps give the answer to you, Matt, that wants to have the floor.
Sorry to disturb you with my question, but stress testing is an important topic for me. But my first question is not addressed to John, because he said, surprisingly, that the stress test is used in the ECB or ESRB as a policy tool and a crisis management tool. While from academia point of view, there are different views, and mainly it might be used only for crisis management and not for policy as expectation. We cannot define or construct a policy based on the tail risks. Expectation is the average of the distribution, which is the baseline scenario. And my question is to other members, and Viral is here. Do you think that we can use stress testing as a policy tool, which might, based on even its realist scenario, but it's sometimes we are completely wrong with the scenario we construct within the stress test. And I was a member of stress testing task force during more than 10 years. My second question, I was surprised by the intervention of Viral, and he made references to Lucas' critic more than twice. As you know, the stress testing is based usually first on static balance sheet, on reduced form, and I didn't see until now any DSG model. And if we took the thought of Lucas, well, money and finance has no role in business cycle. How can we deal with Lucas' critique in constructing our framework for stress testing? To be honest, I didn't understand your reference to Lucas' critique within the stress test modeling and framework. Thank you very much.
I think the final question, I might give that to you and Viral to discuss together, but I'll let you, Nat, also discuss this on the policy part, and then just say a few. You wanted to have a last word because we're running out of time.
Thank you. So I think this is a very good, so as I said before, I do consider showing the facts and thereby enabling the market to actually manage the risks as in and of itself a policy tool. So we have in our latest financial stability report, for example, shown much more aggregate market positioning than we've had done before, so that individual market participants understand where they sit in comparison to the rest of their peers and the markets, so that they would understand how shocks could impact them as a result of that positioning. So there is a real policy power to showing the facts and sharing data back, to Rama's point, sharing data back with the markets. Your question is very interesting because obviously it's clear stress testing helps be prepared for shocks. But I think part of your question is, what about normal times? And I do think there is a use of stress testing and other type of analysis to understand whether in normal times the financial sector is supporting the economy in the most effective way, of whether there are some frictions that ought to be removed. And you can use scenario analysis to tease that out. So I think yes is the answer to your question. And I think that's especially in a world where there's much focus on growth and productivity, I think it's something that needs to be looked into. The final thing I would say, and I think it links to what President Lagarde said this morning about the telling the signal from the noise. I mean, in many of those situations, it can be reasonably easy to list what the risks are. You just do a very long list. Working out which ones actually matter to the provision of vital services to the economy, that is the difficult task. And that is what system-wide stress testing is really helpful for, is to prioritize our focus. And in a world where shocks can come from many, many corners, that is very precious and very important, our focus.
Well, thank you so much. I would say whether we need a sonar or a flight radar.
You want to go underwater?
Or both. I think it seems like system-wide stress test. But in order to keep the time, I think if you have a 2-second comment,
seconds,
John,
because I took on board everything that Rama said, and I agree with almost everything. I think we shouldn't lose, of course, sight of the objective, and it was good that you asked the question, I think, Abdulaziz, because in the end, I think the more transparency that we can provide from the official community to the market, we can have possibly, would the dash for cash have happened if we had been able to show in advance what we knew about how the system works? And I think that's really what we're aiming for, regardless of known unknowns and unknown unknowns.
Well, thank you. That will be the last word, and I'll leave it to you, Connie, to introduce the panel. Thank you so much. And thank you, Viral.